Are you buying a home in 2022? Feel the power of FHA. 3.5% down, high debt to income ratio, great for house hacking. Feel the power of FHA when you're buying in 2022. What's going on, guys? This is Minh with What's a Mortgage. Hopefully you're having a great night. Welcome to our channel. If it's your first time tuning in, do me a huge favor. Please hit the subscribe or notification button so you're notified every time we go live or post new content. We go live every Monday night on Facebook and YouTube at 9 p.m. And we go live on Instagram on Tuesday night at 9 p.m. And we post content daily on TikTok and Instagram. So don't forget to follow us on all our other platforms. Also, guys, this is an interactive channel. So if you have questions, we got answers. And of course, if we answer your question, do us a huge favor, like this video. All right, guys, let's get into it. So tonight, we are going to go over how to buy a home with an FHA loan in 2022. Is FHA the right fit for you? If you're a house hacker, this video is definitely for you. If you're a first-time home buyer, this video is definitely for you. If you can't make up your mind if you're buying FHA or conventional, this video is for you. So, how are you going to buy an FHA in 2022? Let's go over why the reasons people are buying FHA in 2022. Why do people go FHA? This might be you. If you have a credit score under 680, FHA might be for you. The payment is more affordable than you try to go conventional when you have below a 680. Well, should I wait for my credit to get better to go conventional? What happens if your credit gets better and rates go up? So might as well qualify for your FHA loan now. Also with FHA, low down payments. Here's where you see people with great credit but not have a big down payment, go FHA. Also, high debt to income ratio. That helps out with a lot of people, even with good income, good credit. Why is that? What happens when a lender won't use all your overtime or bonus? Let's say you're self-employed and you wrote off too much, but you do make enough money to make the payment. It allows high debt to income ratio. If you are buying multi-units, duplex, triplex, or fourplex, FHA 3.5% down, right? Bankruptcy seasoning, shorter times on short sales and foreclosures. You need help with closing costs, the power of FHA. And also at the end of this video, we're going to go over Kiddie Condo, how to buy an investment property. I said it, how to buy an investment property, FHA, 3.5% down the legal way. Also, we're going to go over 203K. Everyone talks about your home is a liability, not an asset because you're not making money on it. We're going to go over the 203K, how to use your 203K loan, even if you haven't bought it. Oh, I thought it's only for people who bought a home, who has to buy a home. No, if you own a home, you can do a 203K renovation refinance and convert your property into units and rent out the other units. All right, guys? So those are the main reasons people are buying FHA in 2022. If you fit under those categories, do me a huge favor, hit a button below, leave us a comment which strategy or which category do you fall under. So before we get into FHA, the first step you got to do, download our Ultimate Mortgage Guide. Go to whatsamortgage.com and download our Ultimate Mortgage Guide. We give you the 5 keys to unlock any mortgage. Doesn't matter the program. As long as you know the foundation of how to qualify, you can qualify for any mortgage in the United States. Also, go to our YouTube channel and go ahead and watch our playlist. Our playlist matches as close as possible our guide. So if you want to prepare yourself to buy FHA, VA, USDA, conventional, down payment assistance, check out our guide, check out our playlist. It will give you the knowledge you need to prepare yourself for home ownership. All right, that's step 1. Step 2, if you're buying in 2022, you need to solidify your income. Make sure you grab your last pay stub in 2021, especially with FHA. If you're using bonus or overtime to qualify or commission, they want a 2-year history. Make sure you have your pay stub ready, your last one in 2021. Give it to your lender. Even if you buy in June or July or August this year, you want to have your pay stub ready because the lender needs to break down overtime or bonus to calculate what you qualify for, especially if you do use overtime. If you work at a job and overtime is a guarantee and it's on your income, you might want to use it. Make sure you have that last pay stub. Makes the lender's job easier. You want to break down that overtime or bonus. If you're self-employed, like one of my boys here, he reached out, he said he's self-employed, he's W-2 and he's self-employed. You want to get a draft copy of your tax returns. Don't deduct everything yet. They're going to do a 2-year average with FHA. FHA, if you're self-employed, they're going to do a 2-year average. So before you deduct everything, make sure a lender sees the draft tax returns. Let them solidify, hey, you deducted too much. You might not qualify. If we have to do a 2-year average, you might not be able to deduct a lot. You might even owe. Well, at least you set up the monthly payments and see what the payment is, because that affects your DTI as well. So of course, step 2, you want to solidify that income. If you have non-taxable income in January, you should get a new reward letter from Social Security. If you're using Social Security income, you're going to get a new letter. That one, you don't need to go over 2021. You're going to get to use your new income. It's your gross income. It's whatever it is on your reward letter, and you can time it by 15%. So on $2,500, you get an extra $375 on 15%. It's $2,875. That's what you can use as income if you have fixed Social Security income to qualify. If it's non-taxable, gross it up 115% on FHA loan only. Conventional VA, USDA, completely different ballgame. FHA, 15%. Solidify your income, okay? If you have rental income, they're going to go off your tax returns. Of course, if you're buying with FHA with the other units, it's going to be 75% of the gross income, all right? So step 2, solidify your income. Make sure you get your last pay stub, and of course your recent pay stub when you go to your lender. Make sure you get that draft tax return. Make sure you get that reward letter. If you're on fixed income, of course, if it's court ordered, anything else that's not Social Security, just bring the information to the lender. You want to solidify income. People fall out escrow all the time because it's income they told the lender, not income they showed the lender. Don't tell the lender, show the lender. You want an accurate quote. Do you want to waste time driving around writing up offers that you don't qualify for? Show me the money. Show the lender the money. Step 3, you want to validate that credit ASAP. If you're not ready to buy, run your credit on Credit Karma, on any other free credit company. Remember, the scores are not real. You're looking for the liabilities. Of course, if you got that under 640, I might want to have a lender check it. If you're above 640, most likely you're going to qualify FHA. Not all the time, but you have a high chance. You want to run your credit. You want to check all the balances, check the monthly payments. Make sure you put the balance one side, monthly payments one side, in case you might have to pay off debt. And if you check on your credit report, if your court order debt's not on there, add that to your DTI. Court order debt, child support, alimony. If you got sued and you got to make a monthly payment for more than 3 years, you got to add those payments. Government order debt. If you owe money to the IRS or to the state, add those payments, all right? Child support, add those payments. So when you run credit, the goal is to tally up your monthly debts. If you want to prepare to buy with an FHA loan in 2022, have the information ready for your lender. You want to make sure you total up your total monthly payments, and they're going to add that payment to your DTI. Remember, your rent, any insurance, utility, or cell phone is not tied to your debt to income ratio. A lot of you guys reach out to me and you tell me how much you owe in monthly debts. You put your rent in there. Remember, you're going from renting to owning. So do not include your rent, and do not include your utility, your cell phone. If you got a gym pass, do not include that. If you got anything that's not tied to your credit, do not include it. Only court ordered and government ordered debt. So once you do that, also on your credit report, you want to pay attention to something, your public records. So if you're going to go FHA, you have a Chapter 7, 2-year plus. Chapter 11, 2-year plus. Chapter 13, after 1 year of making all your payments on time, you can go with a Chapter 13. A short sale, foreclosure. If you got a repo, most likely FHA is not going to take you until after 2 years plus. Make sure you pay attention to these things if you are not going to let a lender run your credit. If you're going to validate all your own information, make sure you know the monthly payments, the balance, and you check the public record. So make sure you watch this as you go through these steps. Of course, next we go with the FHA rules. So there's debts on your credit that you're going to want to omit or not count. FHA has changed in 2022. It changed in 2020, 2021, but no one's really talked about it. Student loans. Whatever payment is on your credit report is added to your debt to income ratio. Before, that wasn't the rule. They want to hit you with a fully amortized payment. So now, FHA, whatever the payment is on your credit report is what they add to your DTI. Well, Minh, what happens if I don't have a payment? Oh, I'm in forbearance. This says 0 payment. I'm good. No. If you're in forbearance or deferment, whatever the balance is, you take it times by 0.5%. Here's an example. The average student loan debt in the United States is $30,000. So you would add $150 a month to your debt to income ratio. So if it's $60,000, then you would add $300 a month. Make sense? So if it's $100,000, you would add $500 a month to your DTI. But if you are in income-based repayment, which is different than deferment and forbearance. If you're in income-based repayment, whatever the payment is on your credit report is what they add to your DTI. But if they add 0, you get hit with 0. All right. So only when it's IBR 0, you get hit with 0. So that's up with student loans on your credit. So look on your credit report, check out your student loans. Installment debt. This is how FHA works. I see a lot of people giving bad information. If you have a debt less than 10 months old, you can omit the debt as long as the payment is less than 5% of your gross income. So if you make $5,000 a month gross, that monthly payment has to be under $250 a month for you to omit it when it's less than 10 months. Let's say it's less than 10 months and it's under 5%, but it's a car lease. You cannot omit a car lease because they know you're going to go out and get another car unless you return the car and you have proof that you have another car that doesn't have a payment. It's a lease. You can't omit it. Be careful with that with installment debt. Tax liens. I can't buy a house because I have a tax lien. You just need your payment letter and show proof of 3 payments, and they add that payment to your DTI, and you're good to go. If you co-sign for somebody, you need to show proof that they've owned it for 12 months, not 9, not 10, not 11, but 12 full months. You got to show that they've been making the payment either through their bank statement or through canceled checks. Show that they've made the payments. Also with FHA, different than conventional. If it's a car, you got to be the co-signer on the car. You cannot be the main. You hear that? Cannot be the main on the car. You have to be the co-signer. So if you co-sign on the car and you're the main, not the co-signer, even if they have the 12 months canceled checks, you can't omit it. Let's say you're on the car and they're not even on it at all. You for sure can't omit it without the 12 months canceled checks. Okay. So make sure you have that proof if you want to omit that debt. Remember, all this information right here is on our ultimate mortgage guide. So don't forget, go to our guide, download it. Prepare yourself to buy in 2022 with FHA. Make sure you see these hurdles. And I didn't put together some 1-hour guide. I put the important stuff that happens to everybody, why they fall out of escrow. So of course, like, oh, why aren't you teaching this? Do I need to teach you how to count? If you do, DM me. I will help you personally. Not me personally, someone on my team. But these are the things that pop up so often that kills deal. And you want to go FHA, you want to take advantage of the 3.5% down, the lower FICOs, the high DTI, the house hacking. You got to see these potholes. I'm only telling you this because te amo mucho, because I love you. So once we know step 3, step 4, budget. Not that car budget. I know I'm old school when I say the word car budget, and even my producer, director, Annie here, what's a budget, right? Yes, it's foreign to some people, but not the car budget, budget, okay? Set your budget. Once you get your 2-year average of your income, so step 2, take your 2-year average, multiply by 45%. Unless you have people helping you out with the payment, you don't want to eat top ramen forever or air, like, morning air tastes so good on Wednesday, right? You don't want to do that? Keep your DTI at 45%. But unless you want to go higher, we'll show you in a second how to go higher. So take your gross income, times it by 45%. Here's an example. $10,000 a month times 45% is $4,500 a month. Let's say you have $1,500 a month in monthly credit obligations, right? You run your credit, car payment, student loan, credit cards, your Bowflex, whatever it is. Let's say it's $1,500 a month. You subtract that from the $4,500. You know, though, $4,500 is like your max limit. Some of you guys, that's kind of aggressive. Yes, some people it's aggressive, some people it's not. But that $4,500, subtract only the debts on your credit. And then, of course, government order debts and court order debts, right? Let's say it's $1,500, you got $3,000 a month. If you're not happy with the $3,000 a month, you got to eliminate that $1,500 a month in debt to get back to $4,500. That's the name of the game. All right, guys, let's look into our DTI cheat sheet really quick, which is also in our ultimate mortgage guide, fam. Like I said, you got to download our ultimate mortgage guide. So here's where it says, sorry, we go from conservative to be aggressive, be aggressive, right? You got 40% DTI. For those of you who watch Dave Ramsey, 43% DTI, which is the standard conventional, 45, 50, 55. So FHA loan goes 45 to 55. So if you have no debt, you can't go past 45 in mortgage payment. Let's say you have debt. Your monthly debt can go up to 55. Let's say you make $60,000 a year. Your max mortgage payment is $22.50 at 45% DTI. But if you had credit card debts or any debt, you can go up to $27.50, okay? Or let's say you want to stay at 40% DTI, right? Let's say you make $90,000 a year. It's $3,000 is your max mortgage payment if you don't want to go crazy. If you have debts, you can go up to $41.25 on that $90,000, $41.25. See that right there? So you know you're allowed about $11.25 if you want to keep your mortgage payment at $3,000. Play with the numbers. Remember, the front end max is 45. If you want to get aggressive, the power of FHA will allow you to go to 55. These are incidents when I will go to 55. Let's say You have a spouse. Yes, with FHA, if you're in a community state, you got to run the spouse's credit. Let's say the spouse can't go on the loan because their credit doesn't make sense to be on the loan, right? You still got to add the monthly debts in community states. So at that point, you know you can qualify for the payment because your spouse is helping with the payment, but they just can't go on the loan. That's when I take it to 55. Let's say you have someone who also cannot go on the loan, but they're helping you with the mortgage payment. Go to 55. Let's say for some reason you write off a lot, you barely qualify, but you know you make more than enough. Go to 55. You look at bonus, overtime, or commission, and for some reason it's declining somehow, but you know you make the money. They're just not calculating the way you can calculate. Then go to 55. So if you know you can make the payment, but don't when your life is like right. Chill. Remember, you got to enjoy life, so keep that DTI low, all right, fam? So that's our DTI cheat sheet. Now, let's look at our down payment cheat sheet, right? When you're buying, once you decide your budget, you know your payment, you did step 2, 3, and 4, right? This is step 5. You're going to put together your down payment cheat sheet. You buy a house for $350. Look on Zillow, Redfin, whatever home search. You could either go with your standard 3.5% down, 5% down, or 10% down. If you go 3.5% down, your monthly PMI is 0.85. You go with 5% down, your PMI is 0.80. If you go 10% down, who would go 10% down? There's some crazy people that, or they have BK issues why they can't go conventional. They go 10% down. Think about this. A year and a half ago, you got that good 1.99 FHA, and you put 10% down. You know what? That PMI falls off on the 11th year at 10% down. So you got that 199 and that 10th year, even though you got that PMI, you got that low rate, you're attacking more principal and interest. And then on that 10 year, you got that good 199. Why would you get rid of it? Right? Do that 10% down, boom. If you know you're going to stay in that home for a long period of time. So that's why we put that 10% down. 3.5 is the standard. 5% if you want that cheaper PMI, 10% if you know you got that good rate, or you're in that situation where you can't go conventional, but you got the money, 10% down might be the way. On the 11th year, your PMI falls off. You don't have to worry about refinance. Not too many lenders talk about that. You know why? Because they don't read what's on the internet. I'm kidding. I experienced it because I've seen people buy 10% down. So if you're going to figure out how much you need. Step 5, source that money. Source that money, right? Remember, the government, they're not looking for money launderers out there. You got to know where all the dots connect, okay? So if you're going to draw from your retirement, know up front. You can draw from your retirement to buy an owner-occupied property. You can draw it as a loan or a hardship. I would look at a loan first because your money continually compounds if you draw it out as a loan. You can only draw out your contribution up to 50%, up to 50 grand. Hardship, you can draw as much as you want. There's a 10% penalty, but then you pay income tax. It's a lot of rules. So I would look at a loan before retirement. If you've had your retirement for a long period of time, I would look at a loan. If you haven't had it for a long period of time, then you might have to go with a hardship, okay? If you're getting a gift, you have to source the donor's gift. So if the donor's going to gift it, they're going to check the last 2 months of your bank statement. If the donor gifted it to your bank statement, they're going to want to see the donor's bank statement. If the donor gifts it to escrow, unless you're going conventional, FHA, they're going to want to see the donor's bank statement. So make sure if you get a gift from somebody, you get it ahead of time. You get it within 2 months of buying, or they wire to escrow. Uncle Sam, not Uncle Sam. The Uncle Sam doesn't really care. The lender is going to want to see where that money came from, okay? So FHA does have one cool rule that no one really talks about. They allow one-time deposit under 1% of the purchase price. Yeah, you got to source all your other non-payroll deposits unless you're self-employed and you got money coming in and out. If you're a wage earner, you're allowed one. And this is like a lot of lenders have overlays. Unless they sell to Jenny Mae, which buys all FHA loans direct, they allow one deposit that's less than 1% of the purchase price. You hear me? So if you buy a $500,000 home, you allow one deposit for $5,000. Or less. One. Don't go there going, oh, Minh said 1%. Let me keep it all under 5. One-time deposit, all right? I had to deal with that rule like long time ago. That's why I remember it so well. Okay, conventional has one too. We'll go over that next week when we go over conventional. Okay, so step 5, make sure you know where your money's at. Next, if you're buying FHA, and you're getting an equity. If someone's gifting you some money, or you're selling a house, cash out refinance. If you want to cash out to buy FHA, you can cash out FHA, but you gotta wait a year. If you're gonna draw out of a HELOC to buy FHA, it's fine. Or if you're gonna sell your house, make sure you have the seller's net sheet. Know where your money's come from. Remember, FHA is not for first-time home buyers. You can sell a house to buy FHA. Here's a crazy one. Gift of equity. If someone's going to gift you the equity, they can gift you 3.5% down. FHA, here's where the crazy thing is. They can gift you enough to pay your down payment, your closing costs, and pay all your debts off. With FHA's crazy hustle, if you're getting a gift from a family member, they can give you the down payment, give you all the closing costs, and pay off all your debt. If that's not money, I don't know what is, right? So FHA, it helps people. If you're going to get a home from a family member, right, and you don't got that great credit where you can go conventional, give them the down payment, closing costs, cover the rest of the stuff. Well, if it's over $16,000, they're going to have to pay taxes. No, my fam. There is something called the lifetime gift exclusion. They can gift you in 2022 up to $12 million. Unless Warren Buffett is your uncle, you're chilling. Unless you know they got over 12 million bucks to give you, they're chilling. So a couple $1,000, 100 grand ain't gonna break the rule. And they don't have to pay tax on that money. They still got to report it with the IRS, but not pay tax. So you want to put this all together? Step 6, run the numbers. You can go to techielender.com. Punch in all the numbers. We have all the FHA loan limits in there already for California. We have the PMI in there, the upfront PMI, the monthly PMI. Depending on the state you're in, you can go to smartasset.com, put in the zip code. It'll tell you the city tax rate, and it'll calculate your payment. That is step 6. So step 1, you want to make sure you solidify that income. What? Let me verify the steps here, right? Step 1, download the guide. I knew I missed a step. Step 1, download the guide. Go ahead and download the guide. Check out the playlist. Get the income. Get the credit. Figure out the budget and the monies, okay? Once you do that, you figure out the payment. And let's say you're not happy with the payment, right? This is where people fall off. You want to rebalance. If you're not happy, drop the purchase price. Bring in a bigger down payment. Pay off some debt or add a co-signer. And here, a lot of you guys have been waiting. Other things to remember when you are going FHA. The 100-mile rule. So if you are a house hacker or you want to buy the next home FHA, you got to remember the 100-mile rule. That means your home that you have right now that you're going to turn into investment to buy FHA again, if it's within 100 miles, you cannot use vacating rent on your current property. So you own a home. You want to go 3.5% down FHA for whatever reason. If that property is within 100 miles, you can't use vacating rent on this house. Make sense? The next one. For all you house hackers, the self-sufficient rule. So I posted in my IG stories today, which you guys should follow me. If this is valuable information, do me a huge favor. Save this video, share this video, and like it. If I brought you any value tonight, please save this video, share this video, and like it. If you're not following by now, you better start following, all right? So there's this guy who says he has a $950,000 home 3-unit that he bought FHA, but you can't on a 3-unit. So the self-sufficient rule, if you are buying a 3-unit or 4-unit, it doesn't affect single family home, right? Of course, it doesn't affect duplex. 75% of the total gross rent has to be more than the mortgage payment. Okay, so this guy, $950,000, right? So you took 75% of the total rent. Each unit had to rent for like $2,600 on a $950 purchase price. There's no way these little places were gonna rent for $2,600. So he made this little video and I looked him up. He's not even a mortgage lender. He's some guy just trying to go viral and take tips off the internet, but doesn't really know how they work. So if you plan on house hacking or you go to these seminars, they talk about buying 3-unit, 4-unit. You can buy 3-unit, 4-unit with FHA, but make sure they meet the self-sufficient rule. Go to rentalmeter.com, talk to your lender or realtor, find out what do all the units rent for? The total units. So if it's a 4-plex, the 75% of the total 4 units, not the unit you're going to live in, the total. 3-unit, the total. So in California, it's really hard to buy triplex or 4-unit to rent positive or for the rent to be more than the cost of buying it. But other states, all day long. If you're house hacking, you're buying units, you're going to buy one, rent out the other, that you pass the self-sufficient rule. If you're getting a home from a family member, those of you who are blessed, there's a 15% gift. If you don't live in the house for at least 6 months, you only got 3.5%. You have to come in with at least the 15%. So you say you buy a house. It's only 3.5% if you don't live in the house. If you're going to get the house from someone else, they got to gift you a full 15% if they're willing to do that. So if you are getting gifted a house, typically it's 3.5% down, they can gift you. If you don't live in the house, it's 15% down. So they're not willing to give you the full down payment. You got to come in with the difference. Make sure you move in there for at least 6 months. Also, FHA, remember 10% down, that PMI is going to fall off on the 11th year. 5% down, PMI is 0.80. Remember, you got to run credit on your spouse on FHA loan in community states. Here we go, guys. Ready for this? The Kiddie Condo. Meow, meow, meow. Not that kitty, right? Kiddie Condo is a way, it doesn't even have to be a condo, where you can buy another property for your child who's going to school or for your parents or grandparents who cannot qualify by themselves. You're using your income, which is the main income, but you're the co-borrower and they're the main bars. You can buy 3.5% down FHA. Woo! Woo! Right? Woo! If you're buying a single family home for your kid to move in, you can't use the rental income from the rent to qualify, but you can collect border rent income. So if you qualify to buy, you have your home, and little Timmy, little Eddie, or little Annie goes to college, you buy a house, single family home, condo, or townhouse, you would have to qualify for both payments. The child has to have some sort of credit. Start building the credit now. Little bit of income, part-time. You can buy the house 3.5% down. You can collect rent. And eventually when they get old enough or they graduate college, they can refinance in their name, or they move on. You have a property and you have renters in it. Make sense? You can refinance it to conventional if you want, but you were able to get in 3.5% down. Let's say you have an elderly parent who sold their house. You want them to keep some of that money. You can buy FHA, 3.5% down, single family home, condo, or townhome. If you go the duplex or more, it's 25% down. But that's why then you can go 25% down. Might as well go conventional. But you go 3.5% down. They got to be on the loan. They're the main. You're the co. You're just using majority of your income. Guess what? Oh, I have my mortgage. I don't qualify. Check this out. You can add other family members to help you qualify for the loan. Woo! Now, fire or what? Kiddie Condo. Rebecca, the mentor. She's someone I follow on TikTok. I knew the guideline and I knew the program, but I forgot all about it. Sometimes you're caught up in your day, you forget. I remember I did these long time ago in my earlier years, right? When I was like I don't want to outdate myself. I think in 2003, right? That's how old school, triple old school I am, right? 2003. But think about it. If you already have a home and you don't have that 10, 20% down, you can go FHA, 3.5% down, Kiddie Condo for your child or for your grandparents. And when they move on out of school or they pass or whatever happens to your parents, knock on wood, they live for a long time. Now you have a property. You didn't put 10% down, 15% down, 20% down, or 25% down. It has to be a single family home, condo, or townhouse. For all you guys, you're thinking, oh my God, let me call my grandma. Let me make nice with my grandma right now. Let me be nice to my kid. Let me tell him to go to school here so I can buy an affordable home. It has to be a blood relative or be an in-law, okay? That right there is the house hack of 2022 with FHA. Legally buy 3.5% down, no 15% down investment or 2025. All right, guys? And the last one, there's a guy named Robert Kiyosaki who says your house is a liability and not an asset because it doesn't make you money. So you're putting your money somewhere that doesn't make you money. Did this guy forget about rent? You got to live somewhere. A lot of people don't have that 15 to 25% down. But if you bought a home, the secret of 203K. Is that right? K? 203K. Use the 203K loan. They will loan you up to 110% of the new appraised value. If you got a single family home, add an ADU, turn it into a duplex, a triplex, or fourplex. I don't have enough equity. It's okay. I just bought last year. It's okay. They're going to loan you up to 110% of the new appraised value. Also, when the loan funds, and you'll say you can't live there right away, right? Because they're doing so much construction. You can also finance 6 months mortgage payments. After you make your payments for 6 months, you can do an FHA streamline and drop the payment. Yes, the rate is 1% higher, not gonna lie. It is higher, but think about it. You can rent out the other unit and cover the difference. And after 6 payments, you streamline it back down. And you're financing 6 months of the payment. So let's say you bought it for $300. By the time it's being built, it's worth $500, but you got to qualify. But when you do units, not an ADU, if you do units, duplex, triplex, or fourplex, you can use 75% of the gross income to help you qualify. If it costs more than $35,000, check how legit FHA is. They send in someone to make sure you're not overpaying for contract work and it's a good job and all the permits are there. So when it's over 35 grand, they make sure they check everything because they're the one who releases the money, right? They disperse the money to pay your contractor. So it's really important that you understand that this 203K, you turn your liability into an asset. How much easier it is, fam, to save 3 to 5% down, buy a home, and then do a renovation, turn into units. Who can come in 20, 25% down? You? No, me? Maybe, but you can go 3.5% down FHA. As long as you qualify with your DTI and your credit, you can do it. If you do units, remember, you can use 75% of the gross to help you qualify. So Kiddie Condo and 203K is a way to go if you're going to use FHA to buy in 2022. But for those of you who aren't doing something like that, but at least now you know how to get through the hurdles, especially if you're getting a gift, especially if you don't know how to source your money. This is a way for you to go over your hurdles so you can buy and have a smooth transaction in 2022 with an FHA loan. Guys, if I brought you value tonight, do me a huge favor, save this video, share this video, and like this video. If you do want to talk to me, give us a call, 714 790-9697 or email us info@whatsamortgage.com. All right. And also follow us on Facebook, YouTube, Instagram, TikTok, and LinkedIn. And we want to end all our episodes with our attitude is gratitude. Without you, there is no us. So have a great night.